We are live from Bloomberg's world headquarters in Midtown Manhattan. I'm Matt Miller.
And I'm Kaylee Lyons. Welcome to Bloomberg Crypto, a look at the people, transactions, and technology shaping the world of decentralized finance.
Coming up, a painful month draws to a close as BlockFi becomes the latest crypto firm to collapse. But is there still a bull case? Investor and veteran Wall Street risk manager Aaron Brown will make his argument.
And then there's the bear case. We'll head to D.C. for a skeptic's take. Former SEC official John Reed Stark tells us why he thinks it all could ultimately go to zero.
Plus, Europe is making headway in the global race to regulate crypto. We've got the latest from a key lawmaker.
All right, so all of that is ahead, but first let's get a snapshot of the market. The best way to do that on your Bloomberg terminal, CRYP Go. That is your function. What you'll find is that most tokens are moving higher on the day. Bitcoin by about 1%, and it remains in the range it has been in basically for weeks now, $16,400 so dollars where we trade at the moment. Again, it has been very steady for several weeks, but don't let that fool you because it actually is still down about 19% in the month of November. So keep that in mind. Today, though, Ether is outperforming up about 3%. Right around the 1,200 level, and even more outperformance coming from a meme token, Dogecoin, up about 5.7%. And noteworthy that another exchange, Coinbase, which has seen a lot of volatility post-FTX collapse, is moving higher on the day to the tune of about 2%, along with the gains we are seeing in the tokens, Matt.
All right, one of the interesting things, I think, has been the drop that we've seen in Bitcoin relative to equities. The two were fairly correlated for so long, but the drop that we've seen now in the month after FTX's collapse is one of the worst. Only 5 have been worse in the last 5 years. So it's a rough year for crypto. It's keeping market participants split on the fate of the asset.
We'll see a little bit of contagion whenever one big player goes down.
I'm sure there's going to be more fallout.
I think we have one more big leg down in crypto.
I think overall, the industry is fine.
Bitcoin is coming out of this smelling like a rose.
Bitcoin fundamentals are intact.
We see the same confidence and the full confidence.
The biggest lesson here is that the value is in Bitcoin and self-custody and not crypto.
I think we're going to see some selling off in Bitcoin.
I think we're going to recover pretty quickly.
We see less volatility than we did in the last bear market.
Sometimes you need to battle test. You need to go through crises.
So a big differentiation between the value of Bitcoin and the problems the businesses of trading Bitcoin have generated. The crypto world now nervously watching for further fallout from FTX with a spotlight today on BlockFi. Shanali Basak is here with the latest. Shanali?
Matt, we're tracking the money here because now that FTX is going through bankruptcy, it's in the company of more crypto lenders and brokerages also filing for Chapter 11 protections. And their clients have billions tied up with them. Some of these companies have complicated links given FTX has agreed to lend money to BlockFi and also to buy assets of Voyager Digital, 2 deals that have gone awry. So where do we stand now? In addition to more than the $3 billion owed to the top 50 unsecured creditors of FTX, many of which remain nameless for now, there's another $1.3 billion owed to the top 50 creditors of BlockFi as well. That includes a $275 million claim for FTX and other substantial exposures that a BlockFi advisor says has created a liquidity crisis that has exacerbated BlockFi's ailments. BlockFi has also said that FTX's issues are also likely to delay the recovery of assets. Now, as we await details about BlockFi, Voyager, Celsius, and even Genesis, which is said to have been hiring restructuring advisor Moelis & Company as it weighs options, including bankruptcy, which it has been trying to avoid, Bitcoin prices have fallen by more than 20% since prior to the FTX issues began to come to light in early November. Bitcoin net outflows from exchanges have been the largest in history, according to analysis by Galaxy Digital Research. Now, there are still big players, as you've heard. In traditional finance, they say they see Bitcoin as a viable asset, even as centralized exchanges and lenders have failed. But this is bound to come into the spotlight as U.S. lawmakers investigate the collapse of FTX in a hearing now set for December 13th. The House Financial Services Committee's chairwoman said this is a matter of the harm that FTX has caused over 1 million users. But she also said it's a matter of making sure there's legislation to make sure that digital assets cannot operate in the shadows outside of federal oversight.
All right, Shanali, thanks very much for that. Joining us now is Aaron Brown. He's a crypto investor who writes for Bloomberg Opinion. He previously worked at AQR Capital Management, and he's also the author of The Poker Face of Wall Street.
Aaron, thank you so much for being here. I want to start with a recent piece you wrote for Bloomberg Opinion in which you said, quote, no new regulations will help FTX's customers and creditors. What new regulations would do is block one of the most exciting areas of crypto innovation, which is a new type of financial exchange. No doubt there will be failures and scandals associated with these innovations, but the innovations have the potential to fix problems and eventually eliminate them, while no one can believe that some future round of regulation will be the one to finally solve the ancient problems of finance. So, Aaron, really? No new regulation after this episode?
Well, first of all, FTX was regulated in every essential. So it's not a question of an unregulated crypto. It's not a couple of, libertarian hackers or, offshore in Russia. These were entirely regulated financial institutions who filed all paperwork. They were audited. They were backed by major institutional investors. And the problems we see in FTX appear to be almost identical to the ones we saw in MF Global and other major failures. So it's really hard to believe that some new round. I mean, the issue is whenever regulations fail, when a regulated entity fails, the answer is always new regulations.
Okay.
But Bitcoin was invented specifically to solve these kinds of problems. And it's still true if you own Bitcoin, if you keep your private key, not on your computer where it's connected to the internet, but somewhere secure in cold storage, you're absolutely immune to these kinds of problems.
Okay, Aaron, I guess I get the argument that regulation doesn't necessarily prevent all bad actors from acting badly. But at the same time, if someone's going to break into my house, I'm still going to lock the door. They still might be able to do it anyway, but I'm still going to lock the door. Isn't there a happy medium between installing some safeguards that will help protect the consumer and still allowing innovation to move forward?
Well, regulation is like putting a do not rob me sign on your house. Crypto is like locking your door. And that's the whole point, that crypto offers ways to let you lock your door. You don't have to rely on the SEC in Washington to bring an enforcement action 5 years later and have some complicated court arguments. You just lock your door.
Yeah.
And that's the promise of crypto.
That's the key, right? I mean, that's why Kaylee doesn't keep all of her valuable stuff at Sam Bankman-Fried's house. She can lock her own door when it's at her house. Are more investors learning that lesson the hard way now, do you think? Shonali just told us that there have been more outflows of Bitcoin from centralized exchanges this month than there have been in history.
I hate to be cynical, but in the next crypto summer, the next time crypto assets start going up fast, people are going to do exactly the same thing. They're going to leave their assets in unsecured places. They won't keep their keys, and there'll be losses then. And in traditional financial institutions too. Again, more keep out signs is not the answer. We need locks.
Is this still going to be problematic for the value of crypto assets? I mean, there are true believers, clearly, who are going to keep their own private keys and don't care about regulation or fiat currency or central banks. Nonetheless, if you see the bankruptcy of Genesis or Gemini, that's a real problem for the price of Bitcoin, isn't it?
Yeah, I agree. There's the fundamental use case for crypto, which honestly only convinces maybe 1% of the population, technophiles, libertarians, and so on. We have not convinced the majority of people, or even a significant minority, even 5 or 10% of people, that they really need these crypto protections. They really need these crypto innovations. And instead, you get this wild speculation in things that don't carry with them the crypto protections.
Okay, so how do you as an investor differentiate between those just vehicles of speculation and what actually is a worthy investment? What are you looking to?
I have a very simple strategy, and I've done it since 2011. I keep 2% of my wealth in crypto, and I try to get as broad a exposure as I can. I have no ability to, distinguish who are the good innovators and who aren't. And that means I'm selling when things are high and I'm buying when things are low, and it's been enormously profitable. If crypto goes to zero tomorrow, I'm way, way ahead of the game. And I think this is the rational attitude for most investors, unless you're a true believer, unless you have, carved into stone, God gave you this message that crypto is going to take over. look at it as a reasonable portion of the economy. I believe it will be 2% of the economy in the long future. And to compare that, the internet's about 7% of the global economy. So I want exposure to it, but I don't want to guess what's good and what's bad. Now, I never put money in FTX. I never put money in, unsecured. I keep things in private keys. I use the true crypto underlying functionality.
Okay, so you say you buy when it's low. Would you be encouraging people to buy here when we're 72% off from last year?
Not as a one-shot deal. If you make up your mind, I think crypto is X% of the global economy in the long run, and then get broad-based exposure at that level. But that means you're committing yourself systematically to buying when it's low and selling when it's high, not getting wildly excited because it's gone up, not getting depressed because it's gone down. I think that's the right attitude for everything. It's the attitude I took with the internet back in 1995. I decided it was 5%, and I've kept 5% of my wealth in internet ever since. I believe in diversification. I believe in modern portfolio theory. But this is the right approach.
Does that mean you don't favor Bitcoin, tried and true, the OG, over like Dogecoin, which was a joke? Does that mean you don't care about proof of work versus proof of stake? Does none of that stuff make a difference to you?
Well, okay, that's my first thing is, just the 2%, get diversified as possible. But I do apply some basic tests. I don't do any Dogecoin. I don't do any things that seem to me to be clearly have no fundamentals. I try to look at things where the developers are respected people, are people I trust and I respect, that are backed by institutions, Polychain, Mark Andreessen, Horowitz, things like that, and that have some case where I read it and I say, yeah, that makes sense. That might work. When I see Dogecoin, I say that makes no sense. There's nothing there.
Aaron, great to get you on the show. Thanks so much for joining us, and I encourage our viewers to go to Bloomberg.com and read your pieces on Bloomberg Opinion as well. Coming up, crypto skeptic John Reed Stark, president of John Reed Stark Consulting and a former SEC official. He says Bitcoin doesn't function well as an investment.
Plus, Miami's FTX problem. More on the county's efforts to break ties with the failed crypto exchange.
And Binance CEO CZ reflects on what he learned from the FTX meltdown.
I actually reflect on the FTX situation, and I kind of blame myself for tweeting that too late. I think as an industry, we let FTX got too big before we started questioning some of those things.
Bitcoin's hash rate is at an all-time high, and that is a real indication of the security of the network. On Ethereum, we're seeing the total value staked at 24 billion. That is an all-time high. So we think the infrastructure is working beautifully.
That was Cathie Wood, CEO of ARK Investment Management, reiterating her faith in crypto assets in the wake of FTX collapse. We also heard a more faithful tone coming from Aaron Brown in our first segment. So let's get the counter argument now. Joining us is crypto skeptic John Reed Stark. He is president of John Reed Stark Consulting and former chief of the SEC Office of Internet Enforcement. So, John, thank you so much for being here. Aaron Brown was of one opinion. I understand that you are of a very different one. What's your reaction to the conversation we just had?
Okay, I'm not sure exactly where to start, Kaylee. So stop the clock here. First of all, FTX was not regulated. I worked at the SEC for 20 years, 11 years as chief. I've taught securities regulation at Georgetown and Duke Law School for 20 years. I've been in this space for 35 years. I don't know what he's talking about. There's no oversight, no consumer protections, no net capital requirements, no licensure.
He was talking about the FTX exchange and Gemini and Genesis. I mean, they were regulated in the Bahamas, FTX and Genesis and Gemini here.
They are not regulated. Regulated means audits, inspections, examiners, net capital requirements, all of the things that SEC regulation entails. So they're not regulated. They may have filed something with FinCEN so they could file suspicious activity reports, but they're not regulated. There's no fundamentals to anything that he's talking about. The Bitcoin, crypto, it's mathematical, computational blather. There's no cash flow. There's no nothing.
With that John, but it's
What
not really
regulators?
the point, right? We have to differentiate between Bitcoin, the blather, digital blather that you're talking about, and the centralized exchange, right? This is a business just trading crypto assets. It isn't, FTX isn't Bitcoin or Ether.
No, we don't have to differentiate that at all, because most people can't have the wallet that holds the crypto that is somehow tied up in a computer, in a popcorn tin, under a blanket, in a bathroom.
Everyone
like
can have it. Literally, that's the whole point of Bitcoin. Everyone can have a wallet at home with a private key.
Tell me for what? It doesn't function well as a currency at all. Okay, you can't use it to buy groceries. It's too volatile. It's too risky. It's too, well, that's your problem. Every time you do, you have to spend capital gains.
I've bought video games with it at GameStop. You know, I've used it for a lot of things.
Have you paid capital gains every single time that you bought it? Every time you used it?
No, I haven't.
Of course you haven't. Well, you should, because that's what the IRS would require from you, and just got $80 billion.
Although I bought it at $800 and spent it at $600, so I bought it for $800 and I spent it when it was worth about $600, so I wouldn't have paid capital gains.
But every single crypto transaction is laden with fees, is risky, comes with all these capital gains requirements, and it doesn't function well. And starting in January 2024, those exchanges are going to have to report those transactions on 1099s, just like any other broker-dealer would. And retailers, if you're trying to buy, you know, a Rolex on 47th Street for more than $10,000, are going to have to report that to the IRS. So there's going to be more transparency and more sunlight on these transactions than ever before. And you're completely leaving out all of the dire externalities. Okay, not just that there's no oversight, no net capital, no insurance, no inspection, nothing protecting you in any way, shape, or form. You become an unsecured creditor like all of these Celsius, Voyager, FTX, all of them have become. The dire, FinCEN just reported the other day, 1,241 ransomware payments last year, double the amount of the year before. And I'm an expert on ransomware. It's growing, it's getting worse. $1.2 billion, none of it recovered, no one found. And drug dealing, human sex trafficking, sanctions evasion. Nuclear weapons. The GAO came out with a report that said North Korea was using it to buy nuclear weapons.
Well, we have nefarious activity.
Typically uses dollars, right?
I mean,
don't these crimes normally happen with U.S. dollars, John?
Of course they do. You know, but that sort of whataboutism
at a much higher scale,
is a fraud.
Right?
That kind of whataboutism
at a much higher scale, exponentially more.
And absolutely wrong. That is a flawed and anemic pivot. That's what I teach my law students. What about fiat? What about this? Of course there are problems in fiat. Of course there are. But Bitcoin and crypto have brought in a crypto crime wave of epic proportions. And for what? We already have digital currency. If Bitcoin were around before credit cards and then credit cards came along, that would solve it. There's Cash App, there's PayPal, there's a million ways. There's Zelle that you can use this and you get protection. You're not an unsecured creditor.
What protection do you get with Zelle?
All sorts of protections. You call your bank and you say, this transaction didn't happen. They don't reverse charges. And there's an intermediary.
John.
Oh, absolutely they do.
Nope.
Absolutely. I'll tell you this. All of these intermediaries are critical to the consumer. And forgetting about those intermediaries is absurd. Taking yourself into it's not the Wild West. It's not anarchy. It's Walking Dead-like apocalyptic free-for-all. You have no protection whatsoever.
Okay,
and you are
There's
stuck.
no FDIC in crypto is something we bring up often.
That's right.
So there is a lack of consumer protection. But at the same time, consumers also suffered from Madoff and Enron. And there have been examples in traditional finance where regulated entities have also seen episodes in some ways akin to this. So why do you view the crypto ecosystem as so entirely different?
Okay, first of all, of course there have been crimes, financial crimes. That's what I did for 20 years. But again, crypto has ushered in a new crime wave because criminals have a way to conduct transactions and conduct money laundering like they've never had before. Read the DOJ reports on it, the GAO reports on it, the Treasury reports on it.
Okay.
All of these reports, you can go to my website, digitaltrustwatch.com. I don't make a penny from any of this, not a nickel, not a dime. I'm just out there telling it like it is, speaking truth to power, because this is absurd to think that these kinds of dire externalities should just be ignored as the kind of thing that happens no matter what. Try to make a ransomware payment of $5 million with cash. You can't do it. You can't go to your bank.
You talked about how these are unregulated entities. How much fault should be placed on the regulators for not moving quickly enough in tandem with this industry? Why do you fault just the technology and the idea of it itself?
Oh, well, you know, to blame the SEC here would be like Oswald blaming the Secret Service for letting him shoot Kennedy. I mean, the SEC has brought more than 100 actions in the area of crypto, and they have won every single time. Initial coin offerings, crypto lending programs, SAFs, SAFTs. The SEC has won all of those cases every time they bring these cases in. And as far as regulation goes, they couldn't have been more outspoken. Both Chairman Jay Clayton and then later on Chairman Gensler have made speech after speech, regulatory pronouncement after another, talking about the perils of crypto. Doing, you know, they stopped Coinbase from issuing a lending program. Thank goodness, saving billions of dollars. They stopped BlockFi from doing it also. BlockFi paid a penalty of $100 million. Now the SEC is just another creditor for $30 million on BlockFi's list, but they stopped that lending program and they stopped it from happening. So, and look at the Bitcoin spot ETF. Imagine if that had been allowed to happen, what would go on? So all of these things, the SEC has been very aggressive, and they're just a civil agency. Look, I'm a big-time SEC critic. I wrote an op-ed piece in the Wall Street Journal criticizing the SEC for some things they've done. I've criticized them for what they do on cyber, but not on crypto. I do think DOJ needs to do more. I think that people need to be put in jail. I don't understand. Voyager makes representations that the FDIC has somehow insured the deposits of their customers. The FDIC sends them a letter to stop doing it. Why is no one in jail for that?
John, thanks so much.
I do fault DOJ for that.
Thanks so much for joining us. John Reed Stark there.
Thank you for having me.
Giving us the bear case, I should say, on crypto and much more. Be sure to check out, by the way, our Bloomberg Crypto podcast. It dives deeper than the daily market buzz to explore how this asset class is changing the way we live, in John's opinion, in a very negative way. Check it out every week through the Bloomberg Professional app, iHeartRadio, or wherever you get your podcasts. This is Bloomberg.
We are still trying to understand and discover what really happened, and if the regulation, if the tools that we have negotiated just a few months ago and that we are about to vote in the plenary would have been sufficient. We need to be really, really careful in monitoring what is going on and trying to put in place regulation that would prevent that to blow up out of proportion and to become a systemic threat.
That was EU Parliament member Irene Tinagli speaking with us earlier on Surveillance Early Edition. Regulation, it all keeps coming back down to that, and whether it would have prevented any of this from happening in the first place.
Yeah, it's interesting, especially when you get the MF global comparison, but it doesn't seem like it is that great.
All right, come back to Bloomberg Crypto next Tuesday. This is Bloomberg.